Okay, here we are. Here we go. Another webinar. Really exciting webinar too. Nicola, are you there? You're going to jump in and say hello. Welcome everyone. It's Jason here from Alliance Corp Investments. I'll be your host tonight with this new and exciting webinar. This is called the Ultimate Investor Mindset. Really excited to bring you this webinar. It's the first of its kind, and I'll give you some reasons as to why we're running it shortly. But before I do, I wanted to invite and bring forward Nicola. Nicola is head of our education department. She is wonderful along with her team in terms of helping us put all of our educational events together and a lot of the ebooks and videos and things like that you reference. How are you, Nicola?
Good, thanks. How are you going?
Yes, very good. Now, Nicola's going to be helping me tonight, guys, because when we run these webinars, there's a few interactive things that we like to do with you guys just to keep the energy up. Obviously, look, I would prefer that I was face-to-face with you. I would prefer that we were running live events. Unfortunately, we can't. But look, the purpose behind this particular webinar, this webinar is only for our clients that have recently registered with us. It doesn't go out to our greater database, and it's certainly not advertised to the public. And look, the reason for that is that my passion has always been helping investors. You know, I started the business over 12 years ago. Where I feel most comfortable is in front of a whiteboard with my clients, teaching my clients about how property investment works, teaching you how the finance works. But unfortunately, our business has now reached such a size that that's not possible. So this is my opportunity to meet with you, to answer any of the questions that you have, but also an opportunity for you that if you've got a partner that may have not attended some of the meetings, that you can bring them to these sessions. We're going to run these every couple of weeks and see how we go. I might actually run them every week, but this is a new presentation. I'm not exactly sure how long it's going to go for, so I will race through it pretty quickly because I want to give you guys plenty of opportunities to ask plenty of questions. So make sure that you do. There's a few ways in which you can do that. You can send in your questions. We will pause. There will be sections in the presentation where we'll also pause where you can press the speak button and we can have some dialogue going back and forth as well. But also feel free to ask questions throughout the presentation because I'll be trying to answer them as we go so we don't get bogged down too much towards the end and those questions are still relevant to whatever I happen to be discussing. So when you do put those questions in, Nicola will pop her wonderful face on the screen for us. That will trigger me to stop talking a million miles an hour and address your question as best I can. So what we'll be focusing on tonight is the investor mindset. So we'll touch on that shortly. Before we do, we've got a little bit of housekeeping to get going. So Nicola, did you want anything else to add to that before we get started?
Yeah, so just so everybody knows, if you do want to write in your questions, they are private and they're on your right-hand side. There's a little button in the column that says chat, so you can write your messages in there. If you'd like to request to speak on the webinar, at the very bottom of that column is a little hand that says speak. So if you click on that, you'll request and then we'll just accept you in so that you can ask your questions during the Q&A section.
Fantastic. All right, guys, let's get started and we'll kick it off with the presentation. Okay. All right. So as I said, ultimate investor mindset. So this stuff is really, really important. So let's click through and I'll just grab that. Okay, so what we're going to have a look at, guys, in this one is the current state of the Australian property market. Obviously, you guys are very curious. You know, we've had some interesting times, particularly over the last 6 months, so we'll touch on that. We'll talk about the investor mindset. We'll talk to how to manage and overcome common roadblocks. We'll talk about the network and how we're able to help. And then throughout the presentation, send in your questions, but we'll also make time at the end of the presentation as well. Now, just remember, if for any reason you freeze, your screen freezes, just hit refresh, you know, or reboot the system. We'll answer questions throughout. There's resources on the side panel as well. And you can access all that on the right-hand side, and the videos and things like that. Okay, so why listen to me? Now, some of you already know who I am. The coaches have already gone through a few slides, but some of you may have some partners with you that weren't in the meeting. So I'll very quickly just skim through this. So a little bit about myself. I'm a qualified financial advisor, licensed estate agent, qualified finance broker, licensed builder, an investor. I started very young when I was 20 buying properties, and I'm the managing director of Alliance Corp Investments. So what do? Well, we're a national buyers advocacy group. So we're dedicated to helping investors build portfolios nationally, and we source all different types of properties throughout Australia. Whether it's new, off the plan, established properties. We've been around for over 12 years now. Got well over 1,000 clients, and I've personally purchased well above $1 billion for the clients. What I wanted to touch on first is just have a little chat to you about what's happening in our markets at the moment, because I know a lot of you would have a lot of questions. So to do that, the first thing that we do is we have a look back in terms of where we were at the start of the year before COVID hit us. So you can see there from SQM Research on your screen that our markets were fundamentally very strong. All forecasts were predicting a very strong market in 2020. As you can see there, growth across all major capital cities, except the only one there was Darwin, with average growth nationally between the 7 to 11%. Now, this was underpinned by a shortage of supply, ever-increasing demand, rising rents. There's a lot of infrastructure projects happening nationally, international migration to Australia. And we've just come off the back of a property correction back in 2019, all right, which happens, every sort of 8 to 10 years in our major capital cities, and in the regional areas, it can sort of be 12 to 15 years, right, which needs to happen as part of this chat today also. So very strong. And then, of course, COVID hit us, and you'd know all about it because it was all in the papers. It was all doom and gloom. Property market's going to crash 30 to 40%. A lot of our clients panicked. We shot a lot of videos back then just to reassure the clients this is only a very short-term impact on our property markets and our economy. It's only short-lived. It's not organic in terms of the normal drivers that send our property markets or economies in any particular direction. And once we get through COVID, things will return to normal. But people were scared. We had to remind them, look, if you have a look at the graph on your screen, you've got to be very careful about what you read in the media. All right. I think a lot of you will agree that the media is there to, I'll just adjust that camera slightly, to sell newspapers. They're there to sell news stories. We're very familiar with this, and this is one of the things that we encourage you to do when you're just about to enter the property market, to block a lot of that stuff out, because it has to be sensationalized. You're never going to read articles in the paper that say, look, the property market's just humming along. It's doing what it's done for the last 50 years. There's nothing much to tell, right? That's boring. No one writes about that. It's either the market's booming or it's about to fall off a cliff. As you can see there, from 2010, you had a number of different economists, authors. You had 60 Minutes jump on the bandwagon, and every time that these guys put out these big stories, you can see on your screen what has happened. The property markets have gone up, all right? And it's no surprise that when we now have a look in the newspapers and all the articles, again, everything's backflipped again. So all of a sudden, people have realized that it's not Armageddon, it's not the end of the world, that we've got vaccines around the corner. They may even start distributing some of those vaccines as early as next year, with the view that most people will be vaccinated towards the end of next year. And all of a sudden, the newspapers, all those commentators have backflipped on us, okay? Because again, we don't want to hear about doom and gloom now. We don't want to hear that the market's just humming along. What we want to hear now is that the market is booming. So where are we at the moment? Well, if you actually have a look at the returns on the screen on the left-hand side, had you purchased a property late last year, and look, a lot of clients called us and they said, Jace, what do we do? Like, we literally just purchased. We've just got tenants in. As you can see from the annual growth, if you look at that middle column there on your screen, the markets haven't moved. Right, so over the last 12 months, the markets you haven't lost a lot of ground. You're still up, as you can see. Sydney's still up 6%. Melbourne hasn't done much over that period. Obviously, COVID affected. Brisbane is still up. Adelaide's still up. Perth sort of hasn't done a lot. Hobart's still up. So nationally, you're still up. Yeah. So most people haven't been impacted at all. Now, it's quite the opposite. Yes, COVID, some of the markets have dipped, but not by much, as little as 2 or 3% nationally. It dipped more than that back in 2019 when we had our property correction. But rents are still steady and strong, and interest rates have dropped significantly. So a lot of the clients that we spoke to said, look, you're in this for the long term, right? So never be concerned about what's happening in the property market or the economy in the short term. This is a long-term strategy. However, there are some benefits as to what has happened recently, and the record low interest rates mean that a lot of our clients that purchase properties, their cash flows in some instances have almost doubled because of the record low interest rates. Some of these investors now are locking in interest rates as little as 2.7, 2.8% fixed over 2 or 3 years, right? So it has actually created some opportunities. Now, in the areas that we purchase, it was quite the opposite. While some areas within the established areas of a major capital cities pulled back a little bit, as you can see there, Melbourne in the last quarter pulled back 2%, okay? But where most of our investor clients buy, most of our investor clients don't buy in those areas because it's just, you can't afford to. A lot of them go to the growth corridors. And in those areas, because the government released the home builders grant, would you believe it, the values went up. All right, so a lot of our clients back in March called us up and they just put in an expression of interest to buy, and they cancelled it. And they said, Jace, we just don't know what's going on. And although we try to explain to them the whole long-term piece, they had some concerns. All right, but what has happened now? Those same clients, if they come to us today, if they want to go back into those locations, the land lots in those areas have all gone up anywhere between 10, 20, and 30,000 because all the home builders rushed in and pushed all the prices up. So who would have thought? Yeah. Your prices went up, your land prices went up in those areas, and the interest rates were slashed, which means the cash flow jumped up. So anyone that purchased just before COVID in those areas would be very happy right now. So nothing to worry about there. All right. So if anyone's got any questions, let us know throughout the presentation, and Nicola will jump in. But if you've got any questions about where the market's at or what's happening nationally, feel free to chuck in those questions. All right. So I hope that has demonstrated to you that we very much are out of COVID now. So that should be the last thing on your mind. That's very much in the past. And what a lot of the commentators now are talking about, some significant growth. Some of them are talking about as much as 15 to 20% over the next 12 to 18 months. So we'll see how that pans out. But again, as I said, you're not investing for the short term. You're not buying a property today with a view to sell in 12 months. Some of you will hold these properties right through to retirement, and I'll show you how that's possible as well. All right. What I wanted to talk to you now is about the investor mindset. It looks like you must excuse me. I've got this shocking cold. So I'll try not to cough all over the place. But Nicola, have we got a question?
We do. So we've had a question come in regarding immigration. So with immigration currently impacted and students not scheduled to come back for a while, what is the situation going to be with supply and just generally how will that market be?
A lot of those students and a lot of the international migration, they tend to settle in the city locations and they tend to take up a lot of apartments. Apartments aren't a big part of our strategy. We don't recommend our clients invest heavily in apartments, purely because we have issues with long-term capital gains and things of that nature. So what you'll find is that most of the areas that we sort of target are sort of the growth corridors around major capital cities. We do look at some townhouses in the established areas that we can get for a lower price point, but not as much in the inner city locations or apartment space. Also, too, there's a lot of evidence there of a lot of people moving from our major capital cities into our regional areas. I've got some videos coming out next week about that. So, and it's really interesting too, because over the last 5 years, our regional areas have outperformed our major capital cities. So it's always important to look at diversification, all right? So we look at a combination of the growth corridors, inner city locations, if it's townhouses, and regional. So if you're concerned about one segment of the market, there's plenty of opportunities, because in our business, we look at all segments and we look at all states across Australia as well. So you'll have plenty of options there. Now, the investor mindset, very, very important. All right, so a lot of people sort of fall into property investment. They realize they need to do something, as we all do at some point in our lives. For a lot of people, you know, I wouldn't say it's too late, but it's usually in their later years, and really we need to think about it as early as possible. And often there's not a real strategy there. And, you know, to be an investor, it's not just about putting your hand up an option and by default becoming an investor. It's really about building a system, an investment system that you will adopt, you know, if not for the next 10, 20, 30 or 40 years, depending on your starting point. So there's a lot of elements to this that need to be covered. In terms of the mindset, we've got to be very vigilant in terms of what we're doing and the opportunities that are available out there. We've got to be consistent in our approach. You know, often people might come across a video online or a friend said they bought investment property, you get excited, you jump online, you end up like an Alliance Corp, you get all excited and you want to buy a property. But then what happens in 12 months' time? What happens in 24 months' time? Because life gets busy. What are you doing then? Are you still focusing on your investment strategy? So myself, I get up at 5 o'clock every morning and I have what I call the power hour session. And that's where I focus on all my investments, high-level strategy stuff for the business, the investments for my family, etc. And I'm constantly working on it. Now, I'm not suggesting you need to do that. Don't worry, you don't have to get up at 5 a.m. every morning and do that. But you should be very consistent with your approach, all right? So very important. You need to be cool-headed. Don't panic, all right? For those clients back in March who panicked and didn't go ahead with their expressions of interest, they're kicking themselves because now they have to pay more for those properties. Be very process-bound. It is a system. It's a process when we build these property portfolios. It's not just about buying a property, all right? You've got to step back a little bit and look at the big picture stuff, all right? This is about setting yourself up financially for the future. It could be some of you, it's very much about retirement. For those of you who are young, though, it's all about enjoying that lifestyle in the early years as well. And you know, your kids and paying off the mortgage and being debt-free, etc. And it's mission-orientated. So we'll talk about that in terms of goals. In terms of your decisions, they need to be supported by research, yeah? A lot of people in years gone past, they've come in to see me and they print off a flyer from realestate.com. They go, Jace, can you go negotiate on this property? I want to buy it as an investment property. I go, fantastic, show me all your research. They literally have just got the flyer, right? Because it's local and they know the local area, but they've done no research. They have no idea what the cash flows will be, whether there's holding costs, etc. You know, what the returns have been historically, what they might look like. And they just sort of fell into it. So, you know, we've got to do our research. We've got to be organized. And that's why we've got a big research team to help you with that. It's got to be supported by probabilities, not ambiguous, non-hesitant, all right? Carefree, but not careless, all right? So what I mean by that is that you are investing the long term, all right? And there are things that are going to happen which are an expectation, not something you need to be concerned about, because we have a strategy to deal with everything. So obviously, people's concerns such as things, oh, what happens when interest rates rise? What if I don't have a tenant? What if I lose my job? Don't let those things stop you from moving forward, because professional investors have a strategy to deal with all those issues, right? And it allows you to relax with your investment decisions and approach, provided you get educated and allow your coaches to teach you about that. Don't make assumptions. A lot of people get a concern in their head. They just make an assumption about the outcome, which is potentially all bad, and then that becomes a roadblock for them. So it's really important. So if you break up the investor mindset elements and keep it as simple as possible, number one is goals. Right, we'll go through this all in a little bit more. The next one is education. The one after that is having a strong network, and then having strategies in place, and most importantly, like I said before, taking action, okay, and not hesitating. Now, we've got a poll there, Nicola, is that right, for this one? So would you say you have a strong investor mindset? So just touching on that slide earlier, let's go through and see what people's responses are to this. Do you have clear and defined goals? Look, obviously you're getting educated, but are you reading your ebooks, right? So you're coming into these sessions with the coaches, are you actually going away and following up and reading through all the ebooks and putting time aside outside of your coaching sessions with your coaches? Do you understand the importance of the network? Are you starting to build that network? Are you talking to the brokers, etc.? All right. Do you understand the strategy that the coaches are talking about? Do you understand the finance? And if you don't, are you making sure that you learn more about it? And most importantly, are you committing to the process? Are you committing to your coaching sessions, your property presentations? Are you committing to getting your documentation in order for the brokers? Are you doing all of these things? So there's a little poll that will pop up on your screen. All right. So in terms of goals, super important, right? So we are telling you what your goals are before you even tell us. Everyone's got the same goals. Most people want to retire on an income of about $100,000. Yeah, whether it's a couple or an individual, it's usually about 100K. All right. We want to pay less tax. We want to pay the mortgage off as quickly as possible. Excuse me. We want to set ourselves up for retirement. All right. We want to be financially independent. We want to help the kids. We'd like to go on more holidays and more travel. All right, we're simple people. We don't want a lot. I never sit in front of, excuse me, people that go, Jace, I want a mansion in Toorak with $20 million. I want to drive Ferraris everywhere. Don't get that. But it's important to understand that even an income of $100,000 can be very difficult to achieve. The average Australian income is just $40,000. All right, so that is a shock to a lot of people. Now that's after tax. Excuse me, I'm struggling here. Got itchy throat. I hope that this passes. But anyway, in terms of super, so a lot of people thinking, well, we've got super there as a safety net. All right, don't be so sure of that. You know, the average super balance for people is around 250, and women for it's 150. So some of you are watching this thinking, well, this strategy is all about retirement. Particularly if you're in your 40s, you tend to sort of think that way. But look, we could have some clients here in their 20s looking to buy their first investment property. So for you guys, don't think that you have enough time, right? You might think to yourself, oh, look, I've got plenty of time. I don't need to think about retirement. Well, talk to your parents and ask them what they thought when they were your age. Exactly the same thing. We've got plenty of time. And then all of a sudden, bang, it sneaks up on you, yeah? So we need to start these strategies early. And one of the reasons why we need to start them early is because of this diagram here. So what I'm going to show you is just having a look at sort of what sort of income you might need in retirement. All right. So we've got these calculators that you can have a look at. The coaches can run through these with you, or you can just do this yourself. This is the retirement plan calculators. This is from moneysmart.gov.au. And what we do with this is we play around with these with the client. So for example, let's say a client's retiring at 61. All right, we don't have any income at that stage because we're retiring, we're single. Let's say for a male, as I said before, average income balance is around 200,000. And let's say that individual would like an income of in around 100,000. As you can see there from your screen, a super balance of 250 is not going to cut it. All right, it's just $37,000. You can't do a hell of a lot on 37, particularly if you want to enjoy retirement. You know, you want to travel the world or whatever you might want to do, or you might want to help your kids further, etc. It's hard to do on $37,000. If you want to know what it would look like, now unfortunately for women it's a lot less, and it's harder because the average wage for women unfortunately is a little bit less, but also women tend to have to take a break to raise families and things like that, and it's even less at 32,000. If you wanted to know what it looked like in terms of a super balance, in terms of generating $100,000, well, this is what you're going to need. I think that's enough zeros. Hang on. 1, 2, 3. 1, 2, 3. All right. $2 million to generate $107,000 in super. All right. And currently the average super balance is about 250. So it's just not going to cut it. So my point being is we have to focus on other strategies. We just simply can't rely on super. We certainly can't rely on the pension. It's just not going to work, right? So if you want to play around with those calculators, you can jump online and do that. But that's just something to think about in terms of developing that investor mindset and really understanding that we've got to get cracking on some of these strategies. All right. If you've got any question, guys, about that, send them through. So my point with that one is what I was doing there is I was creating some pain for you. All right. So it's important. I don't want to create pain for you, but if I have to, in order for you guys to really focus on this and take it seriously and not just buy your investment property and then forget about everything and think, oh, we're doing enough. We've got our jobs, we've got a little bit of super, and we've got this investment property. It's not enough. You need to be doing more. That could be a driver. Now, for some of you, it might be gain, all right? Pain or gain. If you're close to retirement, it's pain. if you're young, it's gain. It's like, okay, so I've got retirement, in 30, 40, 50 years, but what can I do today? What can I do today to really incentivize myself moving forward? Well, that's getting a nice house, paying off as quickly as possible, doing a lot of travel with the family and things like that. And you want to do that early. It's not just about retirement. So really important that when you're setting your goals, to be very clear on what you want and understand potentially where you're going to be if you don't do some of this stuff, because some people just don't know. They've just got no clue. Well, there it is. Go into the calculator, play around with it. Be clear on your timelines. Like if you've got a big mortgage hanging over your head and you want to pay it off, well, how quickly are? And there's other calculators where I can show you where you can put additional payments into it from the investment properties to pay down the mortgage sooner. And we might add that into the next webinar as well, depending on how long this goes. But really important, you've got to be motivated and you've got to stay motivated. And this has to be something that you continually work on throughout the year, all the way through to retirement. Nicola, you got a question?
I've got a couple of things. So first of all, we've got poll results. So the question was, would you say you have a strong investor mindset? And 73% of our audience said yes.
Ah, fantastic. That's great news. I would be a little bit concerned if we didn't have at least 2/3. So that's awesome.
Yeah.
All right. So let's keep going through. So the next thing is that once you, yep, sorry, you've got another one.
We've got some questions as well. I'll just do 2 for now because there's a lot coming through. So Jason, thanks for hosting. I was wondering if you think the outer suburbs of Melbourne, like how do you think that they're going to perform?
Yep, sure. So as you can probably see from the media and everything, our economy is going to come back quite strong. We still have a lot of demand in the Melbourne region, but if you have a look at a lot of the research that's coming up and when talking to your coaches, don't get fixated on a particular region. Also, there's a lot of positive news coming out of Brisbane. If you actually have a look at the interstate migration, a lot of people have been moving out of, say, Melbourne and Sydney due to affordability and a little bit to do with what's happening with COVID into some of our regional areas. But Brisbane has had a positive internal migration, so their population is increasing with that migration. So don't get fixated on Melbourne, right? There are other locations. Now, predominantly, we look closely at Melbourne. We look very closely at Brisbane. We're not doing a lot in WA at the moment because we're just waiting to see what happens with the economy. We do a little bit in Adelaide. Adelaide is a consistent performer, but just with Perth and Adelaide, they struggle a little bit in terms of population growth in their economies. They're just not as robust as obviously up and down the East Coast. Sydney is obviously just a little bit harder because of price points, but there are some regional areas up and down the coast that we look at as well. So again, certainly some great opportunities there. It's certainly a strong market over the short term, but remember this is all about the long term as well. So keep your options open and educate yourself on different areas. We have a research division that can help you with that, and we have plenty of reports on all those locations.
Okay, question number 2, which actually comes in to that very well, is it better to live near the property that you're going to be investing in? Absolutely
not. Like this, it's just not necessary, guys. Like think about this: who last opened up the mail or your email and looked at your super balance and where all the money was being invested, where all the company, who knows all the companies, the listed companies, like. I'd be surprised if more than 5% of you knew exactly where all your super was invested. It's because there's no emotion there. Property is the same thing, right? So you're not living in the property. You've got a property manager to take care of it. So just make sure that you're focusing on the best criteria, taking into consideration what we talked about, the portfolio grade strategy. It first starts with your goals, then it looks at looking at your current financial position today, then it looks at how the banks treat you, then it looks at what properties we need to buy in order to satisfy the banks to build this portfolio. Yeah, so it's not purely based on where the property is, and certainly don't worry about it if you can't drive past your property on the weekend. It's not a big deal. It is nerve-wracking when you're buying interstate. If you were to do it yourself, yes, I understand that, but you're not. We've got teams in each of those states to help you buy property.
And Jason, Angie suggests that you drink some tea with some Manuka honey and ginger.
I think next time, yeah, I certainly need to do that. I'm too scared to go downstairs because I've got a house full of kids and dogs. So my wife has got them holding them at bay downstairs so they don't run up.
Struggle through.
All right. Okay, cool. All right. Now, another thing I wanted to mention on the education. So really important that you guys are reading through your ebooks, you're making time at home to do that. I'll tell you a quick story here. Many years ago, I sat in front of some clients and they were about to buy 2 properties. Yeah. I went through everything with them, and then they put in what's called an expression of interest to buy a couple of properties, and then roughly a few days later they emailed me and said, look, we've got a lot going on in the family at the moment and work, and it's too much. Can we revisit this in 12 months? And I said, well, okay, no problem. If you can't make it work, you can't make it work. Yeah. I tried to call them, but they just said they're too busy. They just wanted to communicate via email. So it was a bit weird, but it happens sometimes. Things pop up. Anyway, 2 years later, I was running one of my workshops. The same couple came up to me at the end of the night. She looked very angry. She had a very angry face, the wife. And the husband said, Jace, you won't believe it. We were just watching your presentation and we got really confused about the master facility. We thought 2 years ago that when you freed up the equity from our home to create the master facility, we'd have to pay interest on that loan straight away. So we panicked because we thought we'd have interest to pay on our investment properties and then interest to pay on the master facility. They didn't understand how it worked. They had forgotten, right? Now, maybe that was my bad, but I had presented it to them. They understood at the time, but they've gone away. And during the period of buying the properties and researching properties, they've forgotten how that master facility works. So they panicked and they pulled out. Now, in those areas that they were buying, it was in Geelong and down now southeast, and those properties all jumped in value well over $100,000. And I'd gone through that in the presentation. The wife realized that they blew $200,000 because they simply forgot how the master facility worked, and they didn't ask me about it. They just got nervous. Rather than calling me and say, Jace, we're really concerned about the master facility and making repayments on it, I would have explained, no, you're not making any repayments. That's not how it works. So really important to get educated. If you've got questions, make sure you always speak to your coach first. Don't make an assumption, all right? For example, you get someone in your ear and they go, oh, you should be doing this or you should be doing that, and you think maybe I've made a bit of a mistake or whatever. No. Go talk to the coach first, raise the concern with the coach. If the coach can't alleviate your concerns, well, then you put a pause on everything that you're doing. So immerse yourself in the education. It removes all your roadblocks and misunderstandings. Get professional support, absolutely critical. I'm going to talk to you about the network. You've got to remember, you're building a business, all right? That's what these properties are. You've got money coming in, you've got money coming out. You've got to treat it like a business. And like with any business, you'd never run a business without having, an army of consultants or people to help you build and manage and grow that business. Like anything in life, unless you're super experienced, unless you're a really savvy, super experienced investor, you don't know what you don't know, all right? It was just like when I started my business. I'd never run a business before. I'd never managed a business. All right, I was super confident, but I just didn't know what I didn't know until I made that mistake, right? You don't need to make the mistake when you're getting professional advice. Now, this is one of my favorite topics. This is leverage. All right, I could talk to you all night about leverage. I could run seminars on leverage all weekend. Leverage is by far one of the most powerful tools that you can access. All right, because effectively what you're trying to do as an investor is leverage every opportunity that comes to you. You are leveraging your knowledge, okay, by getting some advice, by getting some educational tools. You are leveraging your knowledge right now watching this webinar. You need to leverage your time, all right? I don't know how many people have missed out on going down the investment path because they felt that they just didn't have the time. How am I going to make this happen? I want to buy an investment property. I don't want to give up my weekends. I don't have the time at the moment to give up my weekends looking at property. I'll put it off to the next 12 months. I'll put it off for the next year, whatever. Again, if you get a good network behind you, you can leverage that time. Same with managing your property. A lot of people ask, do I manage my own property? Hell no. You get a property manager to do that because you're going to build a portfolio of properties. What, you want to manage half a dozen properties across Australia? No way. Leverage your finance. Absolutely critical. As an investor, I want to put a little amount of my own money in with the view that I'll use someone else's money to top up my investments, which will allow me more of my own money to invest in further assets or create a little bit of a buffer for myself. Oh, excuse me. Okay, so really important. Leverage the opportunity. So I'm going to talk about that shortly. Right now, you're with Alliance Corp to get a lot of the benefits that I talked about, but there's other opportunities available to you which are just as important, and they come through our Wealth Accelerator programs, which I'm going to touch on shortly. And obviously, all of this leads into leveraging your outcomes. So super important. Take action. All right. So, and it's continual action. You've got to commit to the process, commit to the meeting, stay focused. some of the strategies that we introduced to you are quite new. So you don't need to jump straight into them. There are ways to sort of dip your toe into some of those strategies. But remember too that for some of you that are quite nervous or buying your first investment property, look, like anything in life, you just got to do the first one. And then once you've done it, you'll understand it, and it makes it easier to do your second, your third, and then it opens you up to all these other opportunities, which I'll touch on shortly as well. But just commit to the process. Now, Nicola, we got any more questions coming up? If not, I'll keep going, or I can. Yeah,
we do. I'll try and keep this brief. So, a question is, what is the difference between a buyer's advocate and a real estate agent?
Yep, so a real estate agent works for the seller. So, if you're looking to sell an established property, what do? You don't sell it yourself, you call the local real estate agent. Now, in the United States, it works a little bit differently there. When you go to buy a property, you call your local, they call them property brokers. So they have a different mindset over there. Our mindset is a little bit different here. We've got this love affair with property, and we think we can just go out and buy it ourselves. But the problem with that, these are the biggest investments you'll ever make. So a buyer's advocate only focuses on working with buyers. They don't sell property. The real estate agents will help you sell properties.
The next question was, and I know you answered this before, Jason, 12 years ago you started Lions Corp, but how long have you been doing this for personally? And can you speak a little bit about your experience?
Yeah, absolutely. So I started when I was 20. So I had an interesting history. I was quite young, and look, my parents separated when I was quite young, as they do with a lot of families. That's not unusual. But I went to live with my dad. My dad lived in St Kilda. I was 15 at the time, but unfortunately, Dad was very sick. He had multiple sclerosis. So I couldn't look after him. Social services saw what was happening in the home there. So they came in, they put him in a home, they took me out. Look, I was very rebellious. I was very upset. So I ended up on the streets for a little while. I was living at friends' houses. Social services caught up with me again, put me into a home with other homeless kids in St Kilda. It wasn't the great environment. You could imagine that sort of lifestyle at that age in St Kilda with other homeless kids. So I didn't finish school. I really struggled, but what I did know is that I was different from a lot of the other kids. I did know that I wanted to be super, super successful. I wanted to follow in the footsteps of my dad. My dad was very successful. He ran a lot of businesses before he got very sick. So I had to move away from that scene, that environment, which I did. I made new friends, and then I focused on saving for a deposit. So I was 20 years old. I was working on that deposit. I told my dad how much I saved. He fell off his chair, couldn't believe it. He was a smart guy. He said, "I'll match you dollar for dollar if you use that deposit to buy a property." Because initially I was tossing up between traveling overseas. He really wanted me to buy property. So he was a clever guy. He said, "I'll match you dollar for dollar," which he did. And then that sort of pushed me into getting a property out in East Bentley. It was a sort of rundown 3-bedroom brick veneer home, had a swimming pool in the backyard. It had a spa, so I bought it on auction day. I hadn't even looked at it. I turned up for that inspection thinking it was an inspection. It was an auction. I had my mates with me. I just kept putting my hand up. I bought it for $200,000. I didn't really know what it was worth. I knew the banks would lend me $205 at the time. And then I started renovating it. All right, I've got my mates over on the weekends, trying to get them to pitch in. They drank a lot of my beer and swam in my pool. Didn't help me out too much with the reno, but I did renovate it. And then I went to a seminar by a gentleman called Peter Span. He talked about this thing called leapfrogging. So your property will grow in value, or you add value, and you pay down the mortgage, you create equity, and then you can take the equity out. I didn't know that. I thought you had to sell a property to access your equity. And then I started buying 1 or 2 bedroom flats. And then at 27, I bumped into a buyer's advocate and said, "My God, you've got the best job in the world. You help people build property portfolios. This is what I want to do for the rest of my life." So then I went hard on all my qualifications that you saw earlier, and then started Alliance Corp. So that was my journey, and what I specialize now personally, aside from the properties, also doing a lot of developments, which you guys can access. I also do a lot of trading as well. So I've got, and then of course I've got the business there that we're expanding nationally as well. So quite a bit happening there, but I just love property. Yep.
Sorry, just a couple more questions. We'll do, can we do 2 more, Jason, or do we need to keep going? Yeah, all right.
Yep.
So one of the questions is about, do you have to set up a master facility?
So when we refer to the master facility, for those of you who've got equity, yes, you generally want to set up, because the purpose of the master facilities we'll talk about shortly is it's used to control your whole portfolio and all your cash flows. Now, whenever anyone asks me, what's the biggest risk with investing in property? It's your cash flows. You never want to be in a position where you can't make loan repayments or cover expenses. You never want to be in that position. That's what the master facility is for. Now, if you've got cash, the master facility is simply an offset facility that will be set up on your investment loan. Yeah. So you'll buy the property first, you'll have an investment loan, the broker will set up an offset, all your income will go there, all the rent will go there, all the loan repayments. We're basically creating a structure that means that it doesn't matter what happens in your life, whether you lose your job or you don't have tenants or there's unexpected costs, the master facility always has a buffer in there to manage all your cash flows so you can sleep easy at night.
And last question for this section. So this question is about the quality of your property selection over volume, and the question is, how many good quality properties do you need to retire on 100K per, if you want the passive income of 100K per annum? Yeah.
So that question, generally we say to clients around half a dozen properties, right? But what I can't tell you is how long would you need to hang on to those properties, because everyone has a different starting point. You might get to 6 properties, but how long did you hold all the previous properties before you got to that 6th property? Maybe you don't need 6 properties. Maybe you're in a much better financial position that we've been able to target properties that have more higher growth. Now, typically those properties tend to be properties with lower rental yields. So you'd have to have a strong income for that. Not everyone has a strong income for that. So the long and the short of it is it's a very sort of broad answer without knowing everyone's individual financial position. But as a general rule, what I say to clients is don't think that you can achieve significant financial goals through property by owning just 1 or 2. It doesn't cut it. 95% of investors have 1 or 2 properties. It doesn't really create significant financial goals. Now, of course, it's different if you had bought those 2 in your 20s and you're now at retirement. But my point is, everything I'm trying to teach you is with the view that you're focusing on doing what's necessary to build a portfolio of properties over time to create enough leverage in that portfolio. Some will be high yielding with less capital growth. Some will have more capital growth, lower yields, and some, which we call neutrally geared properties, have a little bit of a combination of both. But you need to top up that strategy with other strategies that I'm about to talk to you about. All right. So this is one of the strategies that I wanted to talk to you about. This is our Property Wealth Accelerator program. And a quick question on our poll. What is your most important financial goal? Is it comfortable retirement, paying off the mortgage, paying less tax, helping the kids, or become financially independent? So if you guys want to answer that poll, and Nicola will come back to us there.
Live now.
Okay. All right. So what are some of the biggest challenges facing a lot of you? For most of us, when we think about the biggest goals, it's pretty clear. Most people just want to own their home outright. A lot of people want a passive income of around 100,000. But to do that, and as I mentioned before, we don't have ridiculous goals, right? But in order to achieve that, we can't just rely on our jobs, because our jobs are enough just to cover the bills, have a few holidays every year. We can't rely on super, right? Because generally there's not enough going into super, so we need to be doing more. 95% of investors only have 1 or 2 properties, which I mentioned before. It's the 5% of investors that go on to build a portfolio of, say, roughly half a dozen properties or more. Now, some of you might be freaking out because you're looking to buy your first. Don't worry about it. Just get your first, and then over time, as you get comfortable, you'll see how you'll take that journey into getting the second and the third and so on. But I'm just making it clear to you that you've got to get your head around building a portfolio over time. So how do we do that? The main strategies is first, purchase investment properties that don't significantly affect your borrowing capacity, right? That's really clear, because as I said, finance is so important, guys. You're not buying this property with your own money. 90% of the money is coming from the bank. That's why we spend a lot of time looking at your borrowing capacities and your equity positions, and we give you recommendations around making sure that we protect that borrowing capacity. The buy and hold strategy, we target buy and hold because most of you don't want to give up your day jobs and become a full-time property investor. So you can still carry on with your careers, but have the buy and hold strategy ticking in the background. But again, it doesn't work well if you've only got 1 property. Over time, you've got to keep adding more properties to fast track those results. We structure the finance to manage your day-to-day cash flows. Now that's super important, because if you see that there's a bit of a struggle or concern around the cash flows on your investment portfolio, you won't buy any more properties. So a lot of people come to us and sometimes they've got a couple of properties, they don't have a master facility. And if the property has some negative cash flows, they're putting the money in themselves. And it makes them nervous, because what happens if they're not working, or something happens, or they go from 2 incomes to 1? They're not going to be able to cover those costs. And that's what prevents a lot of people from also moving forward. So you need a cash flow management strategy. And then this is one of the most important ones. You can't do it just on properties alone. It makes it hard. You need to also look at other income generating strategies to continue to support your borrowing capacity in the future, so that you can keep buying more properties and start to replace your income. All right, so those strategies through the Wealth Accelerator program, we do that through the buy and hold, which we talked about. We've got the master facilities to manage the cash flows. We've got the income generator, which I'll talk about in more detail shortly, to generate some additional income to replace your income and get your borrowing capacity up. We've got the syndicates that gets you comfortable with doing some armchair developments to further utilize some of the equity that you generate in the future to generate some lump sum payments to smash and get rid of those personal debt. Because you've got to get, part of this strategy isn't just wealth creation, it's getting rid of your personal debt as quickly as possible, because that holds you back. And then the deposit power program allows you to buy your next property sooner. So if you're a little bit short on a deposit, could be 10 or 20K, we're happy to look at lending you that in the short term, just to get you into your next property sooner. So here's an example. Now, you're probably familiar with Gary. We like to use Gary's on some of the videos. I just want to quickly show you where he's at in terms of his portfolio, and just, again, point out the importance in terms of the investor mindset of having a strategy that just doesn't look at just buying a property. It's not just about buying a property. You've got to build a portfolio. Now, the challenge is, this is where Gary's at the moment. So he's got 5 properties there in his personal name, and then we purchased some through the self-managed super fund. So make sure you consider your self-managed super fund as well, if that's something that you're looking at doing, because you can utilize that. I'm not going to go into a lot of detail tonight. I just want you to understand the evolution of your property portfolio over time and some of the roadblocks that you're gonna hit. Now, what tends to happen is people will go out and buy properties, yeah? And then they'll see over a few years that the properties have gone up in value. But a lot of properties don't provide significant cash flow positive income. And the ones that do provide a lot of cash flow positive income don't tend to generate a lot of capital growth over time, yeah? So what happens is, a lot of people sometimes lose interest after a few years. Like maybe after, say, 3, 4, 5 years, sometimes a lot of people will sell their properties because they've seen that they've gone up in value and there's some equity there. But because the cash flows aren't significant in that they're really supplementing their lifestyle, their chosen lifestyle, they get impatient and they often sell the properties, yeah? Because the buy and hold strategy is designed to build equity. As you can see there in Gary's slide, those black areas are the equity, yeah? But that sits in a property, it's not for yours to use. So the only way that Gary can start to generate this equity or generate income that is significant, because remember, most of your income in the early years is used to cover the expenses on the property, yeah? So what normally would happen is you adopt an exit strategy, which is all about balancing the debt. And the way in which you would do that is Gary would wait. So Gary had an 8-year plan, all right? We started, what was it, about 3.5 years or 4 years, back in late 2015. Oh, geez, it's already 2020. So the strategy would have been that once he hits retirement, he then starts to sell off some of these properties, and then he pays out the debts on a lot of the others. So he might pay out some of his super, or sell some of his super, pay out some of his personal name. But because now he's using his capital growth, and he's going to have to pay some capital gains tax on that, he reduces the loans significantly on the remaining properties. And that's how you generate your income. Now, the problem with that strategy is that a lot of people, particularly if you're starting a bit younger, you don't want to sell your properties prematurely. You don't want to sell your properties in 10 years or 15 years, because as soon as you sell that property, it's no longer generating wealth for you. You want to find a way where you can hold on to your properties, but then still generate enough income over time to supplement your income without having to sell the properties. This is the challenge that a lot of investors face, and this is why we set up the Wealth Accelerator program. I've just got a photo of Gary's house. He bought a house in Thailand. He wasn't supposed to. He was supposed to wait to retirement. He wants to retire in Thailand. I don't know what the house looks like. The marketing team just got that off the internet. He says he'll take a photo next time he's there. But he did jump the gun. He shouldn't have done that. But anyway, he's very excited now with where he's at. Now, so Gary now has enough properties. All right. So we all agree he doesn't need any more. But what's happening, he's building that out equity. But I don't want to wait. I don't want him to wait for retirement to start generating additional income streams. So now what he does, he channels his funds into the income generator. So I should be using the pointer. I was pointing at the screen. You can't see me do that. On the screen here, this equity, because those properties we purchased were neutrally geared and cash flow positive, we have enough income in the portfolio to go back to the banks and release more equity. So that equity that he's building, we can actually release that and we put it back into the master facility. I think I've got it on another slide somewhere, which I'll show you. Now that equity, we don't let it just sit in the master facility, we put it into our income generators. Our income generators are like term deposits, right? To provide Gary with an income paid quarterly, but he can also use that income to release more equity from the property portfolio. Because again, remember, banks need income, all right? They can see Gary's got equity, they do the valuations. How do we get it out? We need income. And this is where, unless you find ways of generating additional income, you could get stuck in terms of getting the equity out. Now what Gary does is that income generator is also a holding account for when developments come along that he can invest directly into our development syndicates. We do townhouse developments, I'll show you shortly. What that's designed to do is provide him with lump sum payments to smash your personal debt, but also contribute to cash flow positive income that you can generate. Those returns are higher because he's actually investing directly into the syndicate. So you can see how this works. You start with a buy and hold strategy for long-term wealth creation, but you also invest in income generation strategies to get your borrowing capacity up so you can release your equity in the future, but also start to use that strategy to replace your income over time or get your targeted income up without having to sell the investment properties. All right, that's the model. That's what we're trying to help you with further down the track, right? I get it right now. You're just trying to get your head around buying this investment property. I get that. But over time, this is your long-term strategy, to achieve your financial goals. So here it is again. You've got your master facility, as you can see here. The equity that you build from the portfolio will go into the master facility. The reason we can release it is because you're using some of this equity or additional income. So for some of you, you might be buying investment property first before your home, or you may have already paid the mortgage off. Any repayments can go into the income generator and then into the syndicates. If you average out the return on the income generator syndicates, and again, I won't know what proportion of funds you put where, but let's say it's a 12% return. What would you rather? Would you rather have $100,000 of your equity sitting in your portfolio like Gary has, or would you pull it out and put it in income generate 12,000? Or what about when your portfolio's got 250K in equity? Do we leave it in the properties doing nothing, or do we pull it out and put it into these programs? What about in the future when your portfolio's got 500K in equity? Again, do we leave it in there, or do we put it into these programs? Now remember, this is just the income generating the syndicates. On top of that, you've got your property portfolio, because when you do go to retire, you will sell a couple of them when you retire, yeah? But you don't need to sell them prematurely, right? And of course, you've got super on top of it. So there's other income streams I haven't mentioned here. I'm just bringing up these ones that relate to the Wealth Accelerator system. So how does the income generator work? Well, basically, think of it like a term deposit. All we basically do is we use any funds that you have available. So some of you might be buying an investment property, but it doesn't settle for 6 to 12 months. Put your deposits in the income gen, because in that period, you'll get a return. Or after you buy your property, you have money left over that we can't yet use for a purchase. Don't let it sit in an account or an offset or a savings account or your master facility. Put it in the income generator, which is a term deposit. The funds are used for deposits, for the deposit power program. So that's where other clients dip into the fund to top up deposits, and then we take caveats out on their properties. So it's a security against real estate. Also, some of the funds are used to cover deposits on development projects. Like, for example, this is the Beaumont. You can see this online. This is our syndicated division. This is where in the future you'll be able to use some of your equity and invest in some of these projects. We just do small infill townhouse development sites. You invest with us. I invest. My family invests. The staff invest. These ones are purchased, have a price point of between $600 to $700, so very affordable. Some of the clients hold on to these The public buy these, and sometimes our investor clients come along and buy these. But these projects allow you to generate lump sum payments to really smash your mortgages down. They can take anywhere from 12 to 24 months, depending on whether we've got plans or permits or whether we buy raw sites. The income generator is also a waiting list to get into those developments. So if you want to get in the developments, you go on the waiting list. So we know that we've got clients ready to go. Because as you know, I don't know if any of you have had experience with developing, but when you come across a site, you need to move quickly. So that's why the fund is there. The fund itself is very competitive when you compare it against term deposits on the market today, as little as 1%. The funds at the moment generates around 7%. Which goes up when interest rates go up. So if you were to put your deposits, let's say you're buying a property and it doesn't settle for say 12 months or so, if you put your deposits in there, when you go to settle, you could generate another 5 or 6K. All right, so imagine that when you go to settle on the property in the future, you also get another 5 or 6K dumped into your bank account. That can help you cover some costs, etc. It's very flexible in that you can do early withdrawal. If for some reason you put money in and you need to get out, usually the term's about 12 months, but if you need to get the money out, you can. We just don't pay you the last 90 days of interest that you would have incurred on those funds deposited. You can also add, so some of you are quite good savers. You might be looking to buy your first investment property, but you're still saving a lot of money each month. You can keep just putting money in each month. So you can build up the funds that can also help you get into your next deposit sooner to help you purchase that next property. So there's some great benefits there. These programs, one of the most important benefits is that it will increase your borrowing capacity because that additional income will also help get your borrowing capacity up to help buy future properties. You'll get quarterly payments, and you can also use those funds to pay off personal debt. So if you've got some spare money there or offset facility or whatever, put in the income gen. And then you can send that money back to paying off your personal debt, your repayments, to pay that off a lot more quickly. So again, when I talk about the investor mindset, you've also got to look at all the opportunities out there and do everything you can to get the best possible return available to you. Now, you might ask, why have I got a cup of coffee there? It's an interesting one. When I regularly catch up with my coaches and I talk to them about their clients, a coach not too long ago said, oh, look, my client had the ability to put some funds in. They were settling within 6 months. And we worked out there was about just over $2,100 there for them at settlement. They said to me that it didn't seem like much of an investment, so they might not bother. All right, and I'm like, what do you mean you might not bother? All right, have a think about it. How many of you drink coffee? And we love coffee. How many of you have picked up those little coffee cards, right, where you get 10 stamps? You'll pull out that coffee card every time you go to buy a coffee. Yeah, for what? $4.50. The income gen, you fill in a form. That is it. You fill it in once, and everything's done. Everything's managed for you, right? But you'll take that card out for $4.50, right? But you won't consider a $2,000 filling in a form to get $2,000 a worthwhile investment. Everything you do has to be geared towards getting yourself ahead financially as quickly as possible. Whether it's investing, putting some budgets in place, all right? Leveraging every dollar that you have. Never have money sitting in a savings account or a term deposit at 1% that's not working for you, all right? Everything has to move forward. And why is this so important? You might think, Jace, what's the big deal? It's 2K. Well, how about this, right? Albert Einstein famously said that compound interest, right, is the most powerful force in the universe. He said compound interest is the 8th wonder of the world. He who understands it earns it. He who does not pays it. Have a look at this 2,000 investment. I would have said to this client, look, just humor me, right? Fill in this form. It'll take you 30 seconds. You'll get a couple of $1,000 in about 6 months' time, right? On that property as well. Put it into the property. Yeah. Let's say, for instance, your average returns on those property when you include capital growth and yields is around 10%. Argument's sake, right? Look at how compound growth works. If you're in your 50s, right, that $2,000 is $5,000, all right? Certainly still nothing to be laughed at. What about if you're in your 40s? That $2,000 at 10% compounding growth is $13,000. What about when you're in your 40s? Your 30s, $34,000. And look at what happens if you're in your 20s and you put that 2K in. That's $90,000, right? That is significant, right? So that's surely better than the effort that you go to for that extra stamp on your card for $4.50, but you don't make the effort to do the little things now, which makes such a big difference later. So just something to think about in terms of the investor mindset. All right, now network is absolutely critical too. All right, so it's really important. So I'm just going to run you through the network and some of the advantages there. You've got the education team. So again, whenever you see webinars pop up, have a look at them, or any videos. Make sure you sit down, read all the ebooks, go through your coaching session. You've got the coach there to run all the sessions, also put you in contact with whether it's brokers, accountants, financial planners. The coach is there to do your portfolio review. So every 6 to 12 months, he's going to be doing portfolio reviews to sit with you, assess the portfolio, working out whatever we're doing next. Are we buying another property? Are we putting more money in income gen? Are we releasing equity? Are we putting some money into the syndicates as part of the long-term strategy? The national research team, make sure you read all the location reports, have a look at the research. We have a dedicated research team in the business and they analyze the data nationally. We've got the acquisitions team, acquisitions managers and buyers advocates across the country, assessing all the different markets. You've got your post-purchase team. All right, so once you put in your expression of interest or your offer, if we're buying established property, etc., you've got your building inspectors, you've got your solicitors there, you've got the post-purchase team to take care of everything. In terms of the developments, we have the development team. All right, so we've got our sales agents, project marketers, project managers, and development managers. So again, this will give you confidence. And again, you just dip your toe in. So some of you are thinking, oh, why is Jason talking about developers? I'm just trying to get my head around buying my first investment property. Because this is your natural progression, all right, from you becoming a, say, novice property investor to a sophisticated investor. Yeah, but you only have to dip your toe in. So the investment in our developments in the future are only 30,000. You know, the smallest allocations are 30,000. It's not a lot. You just pull it out of your equity, you put it in, you see how it works. You pull your money out plus your return. You go, well, that wasn't too hard. I'll put some more money in. So you just dip your toe in. Same with income gen. You might have quite a bit of funds there ready to go that's not doing anything after you purchase or even prior to purchasing. You just put a small amount in, see how it all works, get your payments, speak to other clients. All right, got plenty of clients doing this. Get the confidence, dip your toe in, and then over time, as your confidence grows, you can do further investing down the track. All right, so the AC network is super important. Now, what you can't see, because my camera has covered it up, but in the bottom right-hand corner, we're also bringing on board our personal banker service. The personal banker service is a dedicated team to also help clients budget with their money. One of the biggest opportunities I see with my clients is just simply having a budget and sticking to it and having someone there to really sort of give you a bit of a hand with that. That can make such a difference again, because as you saw, just you saving, say, $2,000 through some budgeting, that doesn't significantly impact your lifestyle, can become $90,000 in 40 years, right? So we've got that service coming online next year to provide you with regular support. Now, roadblocks, super important. So what are some of the common roadblocks? Simply getting cold feet. How do we alleviate cold feet? Do your homework, yeah? Get educated, learn everything you can. As soon as you have a doubt come into your mind, you call your coach and you say, look, I've got some concerns. I need to have a chat to someone. Yeah, because everyone gets it. Sometimes people are really excited. You know, they buy property, they put an expression of interest. Other people freak out. So it's natural. But what will help you get through the process is becoming empowered. If you feel like you're in control, if you feel like you're empowered because you're understanding and you're super confident in how it all works, it's very easy for you to overcome that. You might have a partner that's not on board. Get them to watch the masterclass videos, or get them to come into the sessions, or get them to watch these webinars. Get them on board, get them engaged. Be very careful about what you read in the media. Look, it's all positive at the moment, but be careful, because had you been in this position in March, you may have cancelled the process. And as I said earlier, it costs you $10,000, $20,000 or $30,000 in a lot of those areas. All right, you need to stay focused. You've got a strategy in the place, you've got the support, you've got the education. Don't let other people come into that space, because everyone's an expert with property, yeah? Financial concerns, it's the finance that helps you alleviate that. So go back to understanding how the master facility works, why it is set up. It is set up to manage all your cash flows. It's set up there so that it doesn't matter what happened, you can always go back to the master facility and rely on that. Trust issues, you know, sometimes people, you know, am I making the right decision? Am I getting the right advice? Who are these people? All right, again, do your homework, jump online, you can see all of our positive reviews. Speak to our clients, right? So we give you our phone numbers to our clients. Just call them up. Have a chat to Gary. Gary will take your call, all right? He's happy to have a chat. A lot of people need to know they're getting a good deal. Well, I can certainly tell you in terms of the long-term strategies, I challenge you to find another company that does what we do, not just in terms of helping you buy a property, right? Because you don't even need us for that. You can go to an auction, just put your hand in it longer than anyone else, right? But in terms of a long-term strategy that takes into consideration your borrowing capacity, equity position, and those other programs to help you build your portfolio, hang on to it, but also generate additional income streams, I'll challenge you to find that, right? But when it comes to your property purchases, there's an incredible amount of research there. That's why we send you the properties in advance. So we give you plenty of time to do your due diligence, and also post-purchase, post-property presentation. It can take a number of weeks before you're in a position to go unconditional on that purchase. You've got plenty of time then to do your homework, do your due diligence, all of that sort of stuff too. So they tend to be the most common roadblocks. So guys, in finishing up tonight, I don't know what the time is. I'm not sure how long that took, but I'm sure Nicola's got some more questions for us shortly. But as I said, be serious about your goals, right? Write them down, discuss them with your partner, add some timelines, lock them in. Keep getting educated, put the time aside in your calendar. These are the biggest purchases you'll ever make in your life, so make sure you're educated. Leverage off the network, all aspects of the network, it's there for you. Strategy, learn the strategies, all right? Get comfortable with things like income gen, get comfortable about dipping your toe into some of the syndicates, because it's those strategies that are going to make all the difference in the future when you're going, well, I'm really happy with my portfolio. They've all gone up in value, but our lifestyles haven't changed because we don't have significant cash flows there to go on extra holidays or do stuff with the kids or pay down the mortgage sooner, yeah? That's why you need those programs. And most importantly, commit to the process and take action. All right, so Nicola, how long have I been doing this for?
Just over an hour.
Oh, just over an hour, it's not too bad. Okay, because I was hoping to do it in around an hour, so that's good. All right, what questions have we got?
Oh, so many. I'm going to blast through them. So I think what we'll do is just try and get through them quickly. Sure. And then if people have any questions, if we can't completely answer them, we'll have a senior property coach call the individual tomorrow to elaborate further and specific information.
So yeah, we'll get your coach to give you a call, guys. I'll try to give short, sharp answers. I find it hard sometimes, but we'll see.
There's so much information to provide. So, okay, question one. Do you recommend purchasing property out of super funds?
Sorry, in your self-managed super fund?
Well, it said the question was using your super fund, but I think you can explain about self-managed super funds and things like that as well.
Yeah, so if the question was consider your self-managed super fund, absolutely. Like, we'll get the financial planners involved, but very quickly at a high level, average super funds have averaged around 6 to 7% in terms of balanced funds, you call it the last 10 years, yeah? But if you take out your super and you put into property, you're leveraging it. So instead of getting 6 or 7% on, say, 130,000 that you might have in super, if you put that into a $400,000 investment property, you're getting 6 or 7% on the 400,000. So it's all about leverage. So again, the coaches can go through that. We've got plenty of ebooks. It's just about leverage, like what I talked about before. The leverage is better. Yep.
Okay. Based on the average income across Australia and current market trends, how long would you predict it would take to obtain 10 properties? Obviously, again, specific to the individual, but
yeah, it has to be specific. So if you excuse me, I'm dying. If you look at Gary's situation, when we started his portfolio, he pretty much paid off his home, so he had all this equity. So Gary, I've got some water here. It doesn't help. I've got an itchy throat. Gary, we were able to buy multiple properties because Gary had enough deposit to buy multiples at each time. I didn't have to buy him a property and then wait for the property to grow in value before I could pull that equity out and help him buy another one. So if you've got plenty of equity or you've got plenty of cash, yes, we can fast track your acquisition. Now, the other flip side is, though, you need enough borrowing capacity. So some of you might have a lot of equity and cash to cover deposits, but your borrowing capacity is low because of your cash flows, right? So that's where I've got to assess your cash flows and work out, target more high yielding strategies or look at things like income gen programs to work out how quickly we can buy your property. So the long and the short of it, it depends on your current financial position today. If you've got heaps of cash or equity and a strong borrowing capacity, I can buy them quickly. If you don't, it's just going to take a little bit longer.
Okay, next question. I'm going to do about 5 more, and then
all right.
all we have time for. So, is LMI a waste of money? I know, like, we've done resources around this previously. So
yeah, very quickly, guys. So, what's one of the golden rules as an investor? I want to put in a little amount of money, of my own money in as possible. Now, why is that important? The less money I put into my first property, the more money I'll have to go towards deposits to get my second. Yeah. The less money I put into my investment property, the more money I have left over as a buffer. So we always want to try and make sure you've got a bit of a buffer in case you've got, unexpected costs, etc., or you lose your job or whatever it might be. Yeah. However, if you're someone that has plenty of equity and plenty of cash, and you can afford to put in a 20% deposit because you've just got so much cash or equity, it doesn't make any difference, right? Do an 80% lend. Don't do LMI in that situation. You only do LMI when you're trying to preserve the cash that you're putting in, because you don't have a lot of cash or equity to work with. Yeah. LMI is expensive, but you only pay it once, and it's tax deductible. All right. So absolutely, if you don't have a lot of cash or equity and you want to buy properties quickly, use LMI. If you've got heaps of cash or equity and you don't need to preserve that, then don't do LMI. Do 80% lends.
We have a question regarding free resources, and I'll actually answer that. So one of the questions was where can you go to get more resources. Give you a bit of a break, Jason. There's a couple of places. So as a client of Alliance Corp, you have access to all of our resources. And so if you speak to your senior property coach, they'll be able to put you in, they'll be able to pass on the most relevant ones to you, but they include guides, videos. We have all sorts of different, toolkits and things like that to support you on your journey. So if you just send an email to your senior property coach, or even just to the info@alliancecorp.com.au email, we'll be able to provide you with those additional resources. And of course, you can head to our website as well, where we do have resources available. The next question was, is it too late to start if I'm 45? What should I do?
No, absolutely not. Because look, guys, a lot of the stats are showing us that moving forward, just in terms of where, how far our health programs nationally are performing, is that it's more than likely that 50% of us will end up reaching the age of 90. Yeah, so you've got plenty of years left in us after retirement, and you'll still be investing after retirement. So that's where, just like Gary only had eight years, all right, and now he's got 5 properties in his personal, he's got a couple in his Software Super Fund. And he's going to continue investing in retirement because he doesn't have to sell his properties, yeah? Because I've structured it where he uses the income gen and the syndicate. So even in retirement, you'll have some fun, you'll have some properties left over, but you'll also have some money invested in those other programs that will continue to generate returns. So absolutely, no, you've still got time. But again, it depends on your starting point, and it depends on what your financial goals are in retirement.
Madison suggests some warm water and brandy.
Thanks. Awesome. I'll get on to that.
So you've got a question there. Our next question is regarding Queensland. So one of our audience members has asked about the recent weather changes, especially hail. Should we keep investing in Queensland in the future given these?
Yeah, absolutely, guys, because these are only very, very minor considerations. A lot of people ask us about Brisbane and the flooding and all that sort of stuff. Well, for starters, we don't buy in flood-prone areas. And yes, every now and then they've got some rough weather, but that's what your insurances are there for. Your insurances can be slightly higher depending on which areas you buy. It's not as bad in Brisbane, but up further north in Queensland, your insurance premiums tend to be a little bit higher because of weather and things like that. But absolutely not. Like, there's all these other advantages. Your stamp duties are at 3%, not 5%. Your rental yields are higher. The properties are more affordable, and right now they have positive internal migration happening in Brisbane, whereas there's an exodus in some of the other major capital cities.
Absolutely. Another question is, could you please speak about the quality of the builders that we work with? Because, and do we pay attention to things like the floor plan? And this audience mentioned, it's important to not get emotionally involved in these sorts of things, but what bearing do they have?
Yeah, absolutely. So when we go through our wholesale network, so this is where we're sourcing newer properties, and it might be that we're doing that because it's called a low-cost strategy. You don't have to put as much funds into the property, lower stamp duties because you're buying the land first. Rental yields tend to be high, etc., etc. So that's usually designed based on your current goals and your current financial position. In terms of who we approach, we speak to all the wholesale builder networks. So we don't work with small companies, we work with big companies, volume builders. They could be building anywhere between 200 to 400 homes a year. To give you an example, Glenville Homes is a very big builder. So they're very reputable. We do background checks on these companies, their directors, and we have very tight criteria around their, their specifications, the fittings, the fixtures, all this sort of stuff. Now, in terms of the designs, we tend to look at two things. We speak to the property managers in the area because remember, you're not selling the property within a year. Your first focus is to get the highest rent. So you've got to deliver what the tenants want. So we leave it up to the property manager to say, what are the tenants looking for? What's super popular? But then we also make sure that it's got good resale value because eventually at some stage in the future, you do want to sell. So this is where you don't go for a real budget type investment property. So there are investors out there that aren't educated on this. So they think that as an investor, I get the cheapest house I can find. Well, that's just not going to cut it when you go to sell it in the future. You've got low ceilings, tiny pokey rooms. You don't have quality fittings and fixtures, things like that. So we do spend a bit of time on that. And again, sometimes it's hard to take the emotion out, but that's where you speak to the team and they can provide you all the criteria around how we source these projects. We also make sure they've got to be fixed price, so you don't get stung on additional costs, which a lot of people do. They've got to be full price turnkey properties as well, so you don't have to worry about adding more stuff like the gardens haven't been done or there's no lawn in the backyard and all this sort of stuff. But they're ready just for tenants to move straight into the property.
Another question was: is there a minimum amount to invest in the income generator?
Yeah, not really. Like it's usually in around about 10K. But you talk to your coach. If you got less than that, it's fine. Particularly if you're actually adding, so you can add. So you might have a smaller amount, but you've decided that look, I can save $1,000 or $2,000 a month or something. So if you're putting a little bit more into that, because we don't actually, the income generator doesn't actually generate much of a profit for the business. It wasn't designed for that purpose. It's more of a holding account to help you in the future get into developments, but also help you with your borrowing capacity. So, with the small interest that's payable there, to make it worthwhile, I guess, in terms of our administration, we would like to see that there's a little bit more put in. But if we can see it's a stepping stone to helping you get into your next property, absolutely. And if you're adding savings to it on a monthly basis, we can see it's going to grow and obviously become more worthwhile to you and obviously the business as well to cover our costs.
I'll just go through the poll result before I continue on with some of them.
Yeah, sure.
That have been asked. And just a reminder, if anybody would like to come on the webinar and ask their questions directly to Jason, there is that speak button that you can press to request to join. The question was, what is your most important financial goal? So 18% of people said a comfortable retirement. 9% of people said pay off the mortgage. 0% of people said pay less tax, or a very, very small.
Pay less tax? Are you crazy? Gary was paying $36,000 in tax. He doesn't pay tax anymore. Right? Imagine getting your full pay packet. Right? Now that will happen for those of you who are employed. You fill in a PAYG tax variation, but imagine getting your full pay packet paid to you. All right? So absolutely, there's some great gains that can be made there. Yep.
People are feeling a bit more selfless because 4% said help the kids.
Yeah, okay. I think the kids will be fine. They've got the inheritance to look forward to. Mind you, we've told our kids there is no inheritance, right? So, I don't want them waiting for me to push up daisies. What we do is we set up a master facility for our kids once we've got a bit of equity and we help them build their investment portfolios. Don't give them money. Don't buy them a property. Just do joint ventures, set up the facilities, and they can go down the wealth creation path as well.
And it is a common question we get around how can people set their kids up for financial success through property as well. And we do have an ebook that specifically speaks to this. So if anybody is interested in that, you're welcome to pop a comment into the chat box and I can send that over to you as well. And 68% of people said that their goal was to become financially independent.
Absolutely. Absolutely.
Okay, so on with the questions. Well, someone has asked, will there be a recording? A few people have asked that. The answer is yes. I will send a recording out tomorrow to everybody who attended. So you can go over this if you missed anything or if you joined late, you have that opportunity.
Yeah, or just your partner. As I said before, you might have a partner and they're still humming and hawing, or they're relying on you to feed them information. Get them in front of these recordings. You don't want your partner going into this, with a lot of concerns. You want to, you're a team. You want to be on this together, this journey together. So definitely get your partners involved.
Okay, I'm just checking. Okay, we can do one more question. So, loan to value ratio. There was quite a big question around this, so I've kind of condensed it. So, how does that impact future purchases in your portfolio? There were some specifics, but if you could speak generally about it.
So the loan to value ratio is the loan represented as a percentage of the value of the property. So when we talk to loan to value ratio, we generally recommend that you purchase 90%, up to 90%. So your loan amount will be up to 90%. So what that means is you're putting in a very small deposit. All right. So your loan to value ratio is 90%. That is absolutely important because, as I mentioned before, you wouldn't want to be doing 80 unless you had so much equity and cash. It's not funny because on, say, a $500,000 purchase at 80%, you have to find 100 grand, 100,000 plus your stamp duties and other additional costs. On a loan to value ratio of 80%, it'd take you too long to build your portfolio, having to find over 100 grand every time you purchase. But on a 90% lend, you can easily do that. Now, years ago, you used to be able to comfortably do 90%. You used to be able to do 90% plus LMI, right? But then they tightened it up a little bit. But there are some lenders out there that are still doing 95. So that's how that works. Okay, so I don't know what happened to Nicola. Nicola just bailed on it, so I'm not sure what's going on. Oh, no, she's back.
I'm still here. I just thought I'd let you proceed because there's so many questions coming in. I'm not sure.
Oh, cool. Yeah, let's keep going. I'm all good with the questions as long as people are, happy to hang around.
All right, we'll do just a few more. Do I have to pay off my house before I invest?
Absolutely not. If you do that, it's going to take you forever. And we talk about this thing called opportunity cost. All right. So you have the opportunity here to generate some sort of return, whatever that return is. And if you don't do it, well, that's your opportunity cost. We can't get that time back. So what you have to find a way to try do both if the option is there. Some people take 10, 15, 20 years to pay off their home. And imagine, look, even just that $2,000 investment, imagine it took you 20 years to pay off your home. You had $2,000 at the start of that 20-year period. And instead of putting into your mortgage, you decided to invest at a 10% return. Well, over those 20 years, I can't remember what it was, but it was something like 15,000 or something like that. That's a significant return. So you need to focus on investing. You need to focus on leverage. You need to find a way to pay down the personal debt. Now, remembering that some of your properties are cash flow positive. So some clients are generating $10,000 a year in cash flow positive income because the interest rates are so low. They use that $10,000 per year and they use it to pay off the mortgage sooner. All right, so investing in property, investment properties can be used as a mortgage reduction tool as well.
Absolutely. There are a few more questions coming through that are very specific. So for those people who have put quite a lot of detail into their questions, it won't necessarily apply to the general audience. I'm going to have your senior property coach reach out to you tomorrow. I'll ask the last question for tonight, and thank you everybody for coming. The question is, I don't have enough to invest by myself. What options do I have available?
Yeah, absolutely. The first thing I would recommend that you do is you hassle your parents. All right, so now that's not always an option for everyone, but look, if your parents have got equity there, we've got some ebooks there on investing with your parents and doing joint ventures and things like that. Get them to the meetings, get them watching the ebooks, get them watching the videos. They might decide to do something themselves, but they can release some of their equity and it doesn't impact their lifestyle. They're not responsible for paying off the debt. You just use some of that equity, do a joint venture, you can invest together, but find a joint venture partner. Now, it's either going to be your family or a sibling or someone like that. That is absolutely the best way to get started if you don't have a deposit. Now, if you're short a little bit on a deposit, you can go into our Investor Express program. The Investor Express program is like the income generator, except the return is 10%. So you can put your funds into this, this term deposit and get a 10% return while you keep saving to it. But then once you're close to having enough deposit, like for example, you might be $20,000 out, but still don't have quite enough, we can then offer you the Deposit Power program, which can then make up the difference. Because we see that you've got a track history of saving. I'm comfortable. Look, it's my money, that we're pulling, that I'm responsible for. So, we're comfortable. There's a caveat on your property, so we know that you're going to pay the property. So that can also help you fast track as well. Nicola.
Okay, going through more questions, there's a lot coming through. This question is a little bit similar to the one we had before regarding being age 45. So someone's 55 and their partner is 58. Is it still okay to invest at that age?
Yeah, but always, because you've still got time. So it's important to understand that once you retire, it doesn't mean to say that you still won't be in a position to invest. So we just have to have a look at the horizon in terms of what we're trying to achieve, because one of the most important things is when you're so close to retirement and you've already built up some wealth, it could be in your home, you've got to be careful in that the decision process would be very different than, say, someone who was a lot younger, because you've already got to a point where you've built up these assets. The last thing you want to do is make risky decisions. So we just assess that in terms of what's achievable and make sure that we're basing our decision process on obviously getting you the best return through your property portfolio, income generator syndicates, thing like that, and doing it in a way where you can be comfortable that you're not risking any of your assets in the process. And you only have to look at property over the long term. Property is not volatile like shares. Property can't be worth zero. Everyone needs shelter. We all need a roof to live. So that's where absolutely you've still got time, because you could still be investing 10 years post retirement in a number of various strategies depending on your current financial position. So absolutely, just get educated. Look, if you're not comfortable with it, no one's forcing you to do anything, right? So you open yourself up to the strategies, you learn the strategies back to front. You can get opinions from third parties, provided it's professional advice and not just your mate down the footy club. And if you're not comfortable, you don't do it. Yeah. So you ask the question. If you don't get an answer that you're comfortable with, well then you don't have to do it, or you go get more educated to get the confidence you need to make those decisions to keep moving forward.
Absolutely. I do have more questions coming through, but I think that we probably I
don't mind, Nicola. If there's short questions, that's fine.
Hey,
they're too long and you can't dissect them.
Well, we'll see how short this one will be. So what tips do you have for somebody who's fairly young, so maybe 24 years old, to build up their super fund and potentially move to an SMSF? And is that something you'd recommend? And you might want to touch on, we had Thomas Schwager on our last webinar, so you might want to touch on that as well, Jason.
Yeah. So look, I'm a qualified financial planner, but I'm not practicing, right? So, any advice I give you with regards to super and stuff like that, you need to always speak to a financial planner. But some clients come to us and they say, well, look, I'm thinking about doing something in my super, but I don't have enough. Should I make extra payments into the super, etc., so that I can take the advantages of setting up self-managed super fund? So you just got to be a little bit careful with that, because super does offer a lot of advantages in terms of leveraging, in that you set up a self-managed super fund and leverage your funds, but you can't leverage your funds as much as you can by taking out a loan in your personal name, right? So when you buy property, you can leverage right up to 90%. So again, for a $500,000 purchase, you only need a 10% deposit plus some costs. Whereas if you were to buy that $500,000 property in your self-managed super fund, you potentially need either $100,000 at 80% or 150, because when you leverage in your self-managed super fund, you can't go to 90. Yeah. So this is where we sort of sit with you and you go, well, hang on a minute, where's the low-hanging fruit? Normally when you're young, you try to get those properties in your personal name, get access to some of those tax deductions, but you can keep chipping away with your super over time. So I wouldn't suggest you run out and start putting any spare cash or any extra savings into your super, because you can't leverage it as well as you could properties in your personal name. It's certainly leveraged better than just leaving the funds in the super without leveraging those, but in your personal name, no, the leveraging, tax benefits and things like that are much better.
All right, last one, because I think we could go on forever. So regarding the 6 properties that you mentioned earlier, Jason, is that in both super and cash or just in cash?
Yeah, well, it could be. And again, it depends on your financial goals, right? So it could be a combination of both. But again, it comes down to how long you've hung on to those properties for. So don't get too fixated with the number of properties. It's the number of properties over what time frame. Yeah. So just because you get to your 6th property doesn't mean all of a sudden that you're going to hit your financial goal.
Hi, everyone. Jason's just frozen. So, Jason, I might get you to just refresh your screen. Oh, you're coming back now? Jason, perhaps if you just refresh your screen, we'll have you rejoin. If you could just keep writing your questions in the meantime while Jason rejoins. He might just need to pop out and come back in. His camera's done pretty well all the way through, but I can see he's currently frozen. All right. If you do have any questions, please feel free to continue putting them in the chat, and Jason will continue addressing them. I think.
Sorry, is that better?
Yes, that's better. Yeah, you were just frozen before.
When did I drop out? I don't know where I got to.
Only about 10 seconds ago. So I think you were just in the middle of answering that question regarding was the 6 properties cash or super, and you were in the middle of answering that.
Yeah, okay. And then there was a question about how many properties, whether 6 is enough.
I think so.
That was the last question. Yeah.
So you said you should aim for 6 properties to be set up with about 100K per year.
Yeah.
So, name only or total, e.g., including super.
Yeah. So it could include super, but don't get fixated on the number of properties, because once you hit 6, doesn't automatically mean you're going to hit your desired financial goals, because it's time in the market. So with Gary's portfolio, you notice on the masterclass video, he hadn't made as much equity in the ones that he bought a couple of years earlier, because obviously we're waiting for the market to progress. So it's about looking at roughly how many properties you have in your portfolio and over what time frame have you hung on to those properties to build up that equity, and then ultimately, well, what type of financial goal are we trying to achieve? They're all the different parameters that we have to have a look at. Like, some of you might hit your financial goals with as little as 4 properties, but that's because maybe you bought them in your 20s. Yeah, you know, so everyone's different.
Absolutely. All right, I think that is the end of our Q&A.
Okay, bye. What do I got to have? Hot tea and something? Tea and honey?
Whiskey or brandy recommended.
All right, I'm going to get pissed.
Find some of that.
All right, so guys, look, I thank you so much. Again, this was the first one we run, and we did it purposely because I don't get the opportunity to sit with a lot of my clients anymore. And this is my passion. It's always the education stuff. Just remember, just focus on the investor mindset, get educated. If you've got more questions, the coach can help you with those questions. And I'll be running these sort of sessions every fortnight. So again, if you didn't have a partner that could join you, send them to the next one, etc. I hope you valued tonight's session. I wish you all the best, and just focus on the programs. Remember, this is a long-term game. Stay committed, and also make sure you're investing in the income gen programs, the syndicates, all that sort of stuff, because you'll need that. You can't just, it's hard just on buy and hold. You've got to incorporate all the strategies. And again, it's like anything, dip your toe in. All right, and you'll get comfortable, you get more confident, and then you can expand those other strategies as well. Thank you, Nicola. Thank you for helping tonight.
No problem.
Okay.